This is an update to my global winners portfolio, which looks across 5 different groups of exchange traded funds to find the best performers. Now this month, there's a lot in common with Warren Buffett, who's recently been buying energy stocks. So in this video, we'll look at the reasons behind that. But more generally, this momentum strategy, which we use, is a great way of keeping abreast of what's going on in markets, but also to think about the drivers behind those changes. If you want to keep track of what I'm doing with the portfolio, you can do that on stockcar.io, which is actually sponsoring this video. So now let's look at my global winners portfolio in a bit more detail. So here's the story that everyone's talking about. Warren Buffett, in the latest Berkshire Hathaway meeting, announced that he'd bought some energy stocks, most notably Chevron. And this is a big deal because he hasn't been buying a lot of stocks. He's been hoarding his cash because stocks, he said, were too expensive. Clearly now that he's buying a lot of stuff, it looks as if he's seeing valuations look more reasonable. And what's really interesting is that he's chosen energy as a sector where he's focusing his purchases. And of course, he's known for buying huge stakes in the companies which he likes, sometimes the entire company. But in this case, he's just bought a lot of Chevron, such that now it's become his 4th largest position in his equity portfolio. So how come our global winners portfolio, which is a momentum strategy, is buying the same stuff as Warren Buffett, who's a value investor? Well, remember that those factors will converge when value is performing best and when something like dividend yield, which is another measure of value, is also performing best. Now, if we look across different sectors in the United States right now, the ones which are actually incorporated in this portfolio potentially, you can see that energy has the highest yield of all. So even though we've had a massive rally in this sector's prices, it's still giving the best dividend yield. And that also means that it's not necessarily hugely overvalued. So certainly when momentum strategies start to rebalance, we'd expect to see value occupying more of those funds. And our portfolio is no exception. So let's have a quick recap on how the momentum strategy works. These are the funds which we'd consider. So amongst single country ETFs, we've got 44 countries to choose from. Then we have 18 factor funds, which look at particular investment styles, if you like. We have 11 US sectors, which are different industries. We also have 8 commodity funds, and finally 9 bond funds to choose from. Now this month we've made a change to the way we calculate momentum. Previously, we used risk-adjusted momentum, where we took the momentum over a certain period of time and divided by the volatility of that fund. Now we've changed it to be pure momentum. We also had different look-back periods across each of the different 5 groups. Now we've just got one look-back period, which is 180 days. But it's still the case that we choose one fund from each of these 5 groups to go into our portfolio. And if none of the funds has a positive return over the look-back period, it's excluded from the portfolio for this month. If we look at the performance of this new strategy, both in terms of return and risk, so the strategy shown here in red and the S&P shown in blue, you can see it has outperformed the S&P, and the periods since 2004 when it's tended to outperform most are the ones when the S&P is dropping. That's because the momentum strategy will probably avoid those losses. It really depends on the timing of the rebalancing, which is monthly, to determine whether it dodges the bullet. But certainly recently you can see a divergence between the global winners strategy and the S&P as the momentum has turned negative for the S&P. If we compare the drawdown from the previous all-time high, here in the top panel you can see the global winners strategy, and during 2008 it lost about 30%, whereas the S&P lost over 50%. And in the recent sell-off in March 2020, the loss was comparable with the S&P. In fact, it lost a little bit more. But in the sell-off since the beginning of this year, it seems to have certainly lost less than the S&P. This is what stockcar.io looks like, and if you go into this top left window, you can find my portfolio. Unsurprisingly, I'm the only Ramin on here, so you can just search for Ramin. And here's my portfolio, Ramin's Global Winners. And you can track my performance, but also you can see the recent changes to the portfolio. So if we click on the changes for this week, these are the ETFs which I bought and sold based on the latest momentum. So among the factor funds, for example, I sold IWF, the Russell 1000 Growth ETF, and in its place, I bought Vanguard High Dividend Yield ETF, that's VYM. And if you want to follow that portfolio, you can do that for free. Just click on this follow bell here in the top right of the screen. How did the strategy perform last month? Well, it wasn't great. Our best performer was the Qatar single country ETF, which only lost 3.5%. That was certainly better than the S&P, which lost just under 10%, and our Technology Select Spider Fund also lost a little bit less than the S&P. But we had 3 funds which underperformed, including our bond fund, which was the Barclays Capital Convertible Bond Fund, but also our Growth ETF, IWF, and our Base Metals Fund. All 3 of those underperformed the S&P. So what actually performed best with the benefit of hindsight was the DB Energy Fund, that's DBE, Egypt, which is a surprise because that's in real economic crisis at the moment, given the potential food shortages due to a lack of shipments of grain from Ukraine and Russia. XLE, the Energy Select Spider Fund, was actually flat, which is pretty good considering what happened to the S&P. And amongst fixed income funds, SHY was roughly flat. Then amongst factor funds, the only one which didn't have a huge negative return was the High Dividend Yield ETF, VYM. Now I'll quickly mention before we move on to our actual allocation for this month that you can track our portfolio on stockcar.io free of charge. But if you choose to upgrade to the VIP membership and use the promo code PensionCraft, that's PensionCraft with no spaces, the name of our channel, then you get a 10% discount. Now let's look at the allocations for the month ahead, and let's start with the country selections. Now, given the surge in energy prices which we've seen, it's no surprise that the energy exporting countries, which are in blue above me, are the ones which have had the greatest 180-day momentum. And the country that we chose last month, which is Qatar, that's the QAT fund, still has the greatest momentum. So that allocation has not changed for this month. But you can see the next 2 countries in terms of momentum are also energy exporters. Here over that look back period are the returns of the best 3 and the worst 3 funds. And you can see that Qatar, UAE and KSA have all fallen from their peaks, but certainly less than the S&P say. And if you look at the worst momentum over that period, China's one of the 3. Now that in turn might be a problem for energy in the months ahead. The reason for that is the zero COVID policy which China's currently trying to implement. That's meant in turn that it's shut down many of its largest cities, which are highly productive and which create energy demand. If there are less people outside their houses driving around, driving to work, transporting materials, then that'll reduce demand for oil. And if that's the case, then a lot of the momentum which we've already seen will probably subside. So certainly the momentum for energy will probably subside if this situation persists in China. Next, we'll look at factors. And here it's just a sea of red. There was only one factor which just managed to squeeze in a positive return over the look-back period, and that's the High Dividend Yield ETF, VYM. Any other factor would have lost money over this 180-day period. Notice also that value figures amongst the best performing funds, or at least the funds which lost least. This is a very different pattern to the one we saw until the beginning of this year, when it was very much growth that was performing best. But dividend yield, as we said earlier, is also another measure of value. And it's certainly the one that's going to make it into our portfolio for this month. Here again are the best 3 and the worst 3 factors over this 180-day period. VWM doesn't really stand out hugely from the next 2, but the truly disastrous fund over this 180-day period is IPO. What this tracks are the stocks which have just been listed on the stock exchange. Now let's try and figure out why IPO has been doing so badly. We can look it up on stockcar.io. So we just enter IPO here, and here it is. It's the Renaissance IPO ETF. And if we take a look at its performance and look over the last 5 years, you can see that it had a huge rally along with all of those speculative tech companies. But then since the beginning of this year, actually just before the beginning of this year, the plummet has been fairly spectacular. And if we look at some of the names in the fund, you can see why. And it turns out that many of these companies are those spec tech companies, which were issued during the pandemania and which have now suffered as a result of having poor profits or even negative profits. If we look at our sector choices, here there are no surprises at all. You can see energy's been by far the strongest performer over the 180-day look-back period. In fact, it blows all of the other sectors out of the water. And if we look at the price returns of the best 3 funds and the worst 3 funds over that period, again, you can just see how XLE has outperformed massively. So while the price of energy remains elevated, this is likely to continue. Next, we'll look at commodities. And again, no surprises, PowerShares DB Energy Fund is by far the best performer. But what's also interesting is in second place is the Global Carbon ETF, KRBN. And looking at the best 3 and the worst 3 funds over that 180-day period, you can see how huge the outperformance of DBE has been. What's also interesting is that during this sell-off period, gold hasn't been a great hedge. And in fact, during the month of April, it seems to be down a bit, and silver's been the worst performer. And finally, we'll look at bonds. Now here, everything is red. There hasn't been a single bond fund which has had a positive return over our look-back period. And that means we're not going to include a bond fund in this month's allocation. Even SHY, which is the very short duration treasury ETF, which only buys 1 to 3 year maturity treasuries, that's also lost about 4%. Here you can see the fall in SHY. It's not catastrophic because of course it is a very short duration fund, but given the low volatility of SHY, that is quite a shock. Now what we would expect to see is that as yields increase, the longest duration treasury funds would lose the most, and that's exactly what we've seen with TLT, which is the 20-year plus maturity treasury ETF. So as we've seen, the country choice, the commodity choice and the sector choice are dominated by energy this month. And guess what? We're buying the same stuff as Warren Buffett, which can't be a bad thing. Also remember our offer with stockcar.io, use the PensionCraft promo code and you get 10% off VIP membership. And as always, thank you for listening.